Heads up, everyone, the worse the economic data gets, the more stocks might rally. This isn't just talk, it's the real story unfolding on Wall Street as we approach the end of 2025. When you see youth unemployment quietly climb into double digits and consumer confidence hit rock bottom, your first instinct might be to assume the stock market is headed for a crash. But here's the twist, the Nasdaq has surged over 20% this year, and leading US stocks continue hitting all-time highs. This disconnect between economic fundamentals and market performance isn't random, it follows a clear, established mechanism. At its core, the market trades on expectations, not present reality. Weak economic data actually strengthens market expectations for Federal Reserve rate cuts, creating that peculiar bad news is good news logic. Here's how the chain reaction works. When data like non-farm payrolls underperforms, say, job creation falls well below forecasts, Wall Street doesn't simply see it as a recession signal. Instead, it interprets cooling in the labor market as giving the Fed more room and pressure to cut rates. Currently, the market is pricing in at least 2 rate cuts next year, one more than the Fed's own dot plot suggests. This shift in expectations triggers 2 immediate capital flows. Money pours into interest rate-sensitive treasury markets, pushing bond prices up and yields down. Funds move toward tech and growth stocks, which represent future expansion. But expected liquidity alone isn't enough. 2025 has another unique backdrop, the deepening AI revolution. Capital expenditure in AI has reached staggering levels. Tech giants are generating higher profits with fewer resources, meaning the stock market is, to some extent, decoupling from the real economy. It's now pricing in tech transformation over the next decade, not how well gas stations or supermarkets are doing today. As long as the AI narrative continues and breakthroughs keep making headlines, short-term economic data will struggle to crush market risk appetite. Yet this logic has its fragility. The biggest risk lies in stubborn inflation. If weak economic data coincides with persistently high inflation, consistently above the Fed's 2% target, the anticipated rate cuts may not materialize. When that happens, optimistic expectations can collide with reality, and volatility may spike. Another risk is that the market may have overpriced rate cut expectations, like a movie trailer showing all the best scenes. If the actual film disappoints, we could see it by the rumor, sell the news reversal. For everyday investors, understanding this dynamic means breaking away from the simplistic mindset that good economy equals good stocks. Instead, learn to interpret how data shapes policy expectations, especially the market's immediate reaction to key releases like non-farm payrolls and CPI. Stay cautious, manage your positions carefully, and avoid being caught off guard if expectations suddenly shift. In the final week of 2025, with several delayed key economic reports due, this worse economy, stronger stocks logic will face its real test. Whether it's jobs data, CPI, or other indicators, each release will introduce new variables into the market. Understanding what's happening beneath the surface will always matter more than blindly following the crowd. If today's breakdown helped you see beyond the headlines and grasp the deeper market logic, feel free to like and subscribe for more insights.